Hello, everybody. Welcome to the latest ADIT network webinar for our growing community across Cyprus. My name is Rory Clark. I'm the ADIT manager at the CIOT, and it's my pleasure today to be joined by a leading expert in Cypriot tax, Christos Theophilou. Christos will be talking about the important and very contemporary subject of Pillar 2 and its implementation in Cyprus. Cyprus's new Pillar 2 law was published in December 2024. It implements the EU directive that was issued in December 2022. The new law introduces several key provisions that are expected to significantly impact multinationals and large-scale domestic groups that operate in Cyprus. Christos will today explore the complexities of the new tax law as well as its global impact, looking in particular at how Cyprus is aligning with the OECD's reforms and how businesses can effectively adapt to ensure that they meet the new tax requirements. A little bit of background about Christos. Christos, you may recognize from having done previous ADIT webinars with us, of which we're incredibly grateful to draw on his expertise. He's one of the leading international tax experts in Cyprus, dealing with a range of different areas of tax, and working for Tax and one of the big professional services firms with offices in Cyprus. Christos is also an ADIT qualification holder, an international tax affiliate with the CIOT, having done the ADIT qualification himself a number of years ago, and also is heavily involved in leading and organising ADIT tuition for tax professionals across Cyprus and beyond, to help grow the next generation of international tax experts. Christos will be leading, obviously, with the presentation, but we will be taking questions. So we'll be doing a Q&A session, and Christos may even incorporate some of the questions into his discussion during the slides as they come in. So if you do have any questions at any stage of the presentation for Christos to answer, please drop them into the Q&A box in the Zoom interface. And without any further ado, it's my pleasure to hand over to Christos now. Thank you.
Good day, Rory, and thanks for your kind words, and much appreciated for this opportunity to share our knowledge and our experience when it comes to Pillar 2. Let me share my screen at this moment. So we are going to be able to view the slides. One moment. So I believe that you see my screen, and you see me writing right now on the screen, and everything works properly. In case that something doesn't work, let me know, and I will fix it. So good day, everybody. My name is Christos Theophilou. I am one of the partners of Tax and Cyprus, and today I have the pleasure of presenting to you how Pillar 2 works in general in an international tax level. And of course, we are going to dig down in the nitty-gritty details of the deviations of the OECD model rules to the EU directive and to the Cyprus domestic law as well. I'm very happy and very excited that I will be presenting here. And for this reason, we have decided to provide you a book for free to a lucky winner that we're going to do a draw at the end. So this is the book. It was edited by Professor Garparino. I am co-authoring the chapter of the calculation of the tax base on this book. So if you want to be the winner of this brilliant book, what you can do is that you can see on the top right-hand side here, there is an email there. You can just send an email to Urania saying that just name on the title like a book or a draw for the book, and we will be collecting all the requests, and at the end we are going to do a draw, and you will be notified if you are the lucky winner to collect. We are going to send you the book to your address. So we are very excited for having this webinar today. And let me start right now. So this is the content that we're going to cover today. This is the agenda. We're going to go effectively through the whole OECD model rules of Pillar 2, and then we are going to dig at the end how Cyprus diverges from the OECD model rules. Now, let me begin with giving you a bit of background. By December 2024, the law has been enacted in Cyprus. You will see that you have the links here. If you want to read the law, you can click on the links and read the law itself. The law has been voted by the parliament and it was published in the official gazette a few days later. That becomes a law in Cyprus. Effectively, the law implements the EU directive. This is what we have implemented in Cyprus. And as you already know, the EU directive follows the OECD model rules. Now, what is important to note is that the legislation does not amend our income tax laws here in Cyprus, but what it does effectively, it effectively includes a new legislation, and this new legislation are the so-called Pillar 2 legislation. So this is a completely new legislation, as I already mentioned, and is not something that is incorporated in our domestic law. So, for example, unlike other jurisdictions like Mauritius, that the qualified domestic top-up tax is included in their domestic law, Cyprus has included the Pillar 2 in a different legislation. I can see right now that there is a question in the Q&A that you cannot see the email very good on our background. Presumably, Rory, let me know if we can send this in the chat. Otherwise, I will write it down here in the slides as we go along.
Sure. So I can type it in the answer as well. So we'll get that email address out to everybody.
Super. So the new legislation effectively implements the charging rules. With the charging rule is the income inclusion rule, which effectively works as a super CFC rule. It also works together with the backstop, which is the undertax payment rule. And effectively, we also include in our domestic law the qualified domestic minimum top-up tax that applies together with the UTPR. Now, a key question here that we need to answer is how the Pillar 2 applies in an international level. We all know that all countries around the globe, they have at the first level their domestic law. So this is our domestic law, that the domestic law typically ranks lower from tax treaties. So typically tax treaties, they are a bit higher above, but it really depends from jurisdiction to jurisdiction, whether you are monist or dual estate. And then we also know that in the EU, we have the EU law and the ECJ that ranks on a higher level than the domestic law. Now, the key question here is that how Pillar 2 ranks in all these laws. And the understanding that we have is that Pillar 2, since this is a new legislation, so it works in parallel with the current tax laws. Effectively, we have the same example here together with Pillar 2. So we have Pillar 2 applies on its own, then it overlaps with tax treaties, and then it overlaps with the EU law. But this, again, is done in parallel with the current tax legislation. Now, before we dive into the details, let me say that, again, what is the difference between the model rules and any other income tax law, in order to understand how Pillar 2 works, because it's a new tax legislation around the world, we need to dive into the fundamentals of any income tax law in order to understand how Pillar 2 works. So in all income tax laws, we have the 6 fundamentals. The first one is who are going to tax, what persons. And when it comes to Pillar 2, this is a very wide in scope. We cover all persons, all legal persons, including here, which is very important, including any arrangement that it can be a trust, it can also be a partnership, or anything else that prepares financial statements. So I will say that Pillar 2 is wider in scope in many countries because it covers not just legal persons, but persons without legal personalities that they also prepare financial accounts. Now, then we go to the next question, which is what we are taxing, what is the character of the income. And here I will explain in the next slide that again is wider in scope. For example, when it comes to common law jurisdictions, income is distinguished from capital through the badges of trade. This doesn't happen in the Pillar 2 environment. We tax all income irrespective of whether you are income or capital. Now, the third question is timing. Timing here is based on effectively on accounting rules, which is on the accounting standards of the UP and not based on tax laws. The fourth rule is about how much. And here we also know that the Pillar 2 rules respect transfer pricing. So any amount that is market value or is not market value, we need to do our transfer pricing study and effectively follow the transfer pricing rules. The fifth rule, a very important notion here about source and residence. The Pillar 2 rules are designed to be for resident jurisdiction. It's not about source jurisdiction. So we effectively see a lot of residency rules, but we do not see a lot of sourcing rules. Sourcing rules are missing from the Pillar 2. They are not there. And it's a big deviation from the current international tax environment that we don't see sourcing rules in the Pillar 2 rules. And when I say sourcing rules, is how we tax at source the non-residents. And this is a big issue in Pillar 2, in particular to the PE. So let me give you an example. Assume that you have a company that has a PE in a source state. So let's say this is the state of source, and this is the state of resident. And this company in the normal international tax environment, at the level of the head office, assume that you have a profit of the 100, and at the level of the PE, assume that you have a profit of 50. In the current international tax environment, we all know that this is one taxpayer, and the profits of 50 are taxed in the source state, and these 50 are also taxed in the resident state. However, in the Pillar 2 environment, this does not exist. In the Pillar 2 environment, the 50 are taxed in the source state where the PE is situated, and these 50, they are not transferred up to the resident state. The resident state only tax the 100 that the head office is entitled of taxing. So we see that in the Pillar 2 environment, we don't see any sourcing rules, and we also do not see any rules for the PE that the profits of the PE will be taxed at the resident state, meaning that the PE is elevated, so it becomes like an entity. Is not clearly mentioned in the Pillar 2 rules, but the PE is treated like an entity within the Pillar 2 law. And finally, the sixth rule here we have is about the process of calculating the income, whether we are follow the schedular system or the global approach. Let me explain more a bit what I mean about this. So this is the current tax system around the globe. A lot of countries, they follow the global approach. A lot of countries follow the schedular approach, and a lot of countries follow a mixture. So this is global or the schedular. Global means if you have an increase in wealth, this is income, and you are taxing that income like anything else. Whereas if you are following a schedular approach, this means that each type of income is taxed differently, so you characterize the income differently. When it comes to the Pillar 2 rules, this is a global approach. So everything that is income is taxed, and we have only 2 exceptions. So it's more global and less schedular, because the exception, as we are going to see, is more on the holding jurisdictions, because we exempt dividends and capital gains tax and certain shipping activities. Other than this, is taxable. And this is number 6 on the fundamentals of income tax. And on number 3, as we mentioned earlier, the legal definition of income consists of, around the globe, the source, where if the income has a source, whether the income follows the trust concept or whether the income follows the accretion concept. Within the Pillar 2 rules, there is no legal definition of income based on source or based on trust concept. And trust concept means common law jurisdictions will have this distinction between income and capital, and we follow the budgets of trade. We don't have this effectively, we don't have this concept in the Pillar 2 rules. So everything that is included income in the accounting standards of the UPE, then is income, and then this is taxable. And at the other side, so when we are looking for our tax base that consists of income less allowable deduction, like expenses and losses, we see that in the Pillar 2 rules, we don't have concepts like wholly attribution for the purpose of the income and so forth. Any expenses that they are included in the tax base, these expenses are allowable for the purpose of Pillar 2, and there are no special rules when it comes to expenses. There are just some book to tax adjustment, but other than this, all expenses, they are allowable in the Pillar 2 era. Now, this is all adjustments that we do in our tax base. Critically important, as we mentioned earlier, there are only 2 exceptions when it comes to income. The one exception is the shipping income, and the other exception is effectively the excluded dividends and the excluded equity gain or loss. Anything else is taxable. So Pillar 2 applies to all industries, all types of income. Nothing is excluded other than these 2. And a bit of divergence. The international shipping income, what we exclude are the profits. And profits means income less expenses, whereas when it comes to dividends and gain or losses, it's only the income and we don't exclude the expenses. And what does this mean? It means that if you have holding companies, the income is excluded from the Pillar 2, whereas the expenses are not excluded. So you can still utilize your expenses in a holding company because only the income is excluded. So these are the rules, the general rules, the general framework of how Pillar 2 compares with the income tax laws around the globe. So now let's dive in on the Pillar 2 rules in line with the OECD model. Before I dive into the OECD model rules, let me say again that today, for those that they join a bit late, we are very excited that we're going to give one book for free. This is a book. I am co-author in this book, which is edited by Professor Garparino. This book covers all the OECD model rules and is publicly available. If you want to buy it, we have the links at the end. However, we're going to give one book for free today. So feel free to share your email to include in our draw. You can see the email on the top right-hand side of my background, and then just say that I want to be included in the draw of the book. We are going to include it in the draw, and then one lucky person will get the book at the end, and we'll send it to you via post. Now, this is the 6-step process, how we are calculating the income of the Pillar 2 rules, and this is what we are going to do right now. So let me go one by one. So this is step one. In step one, we divide step one in three different sub-steps. In step one, which are the scope rules to see whether you are in scope or not. The first thing is that you need to clarify whether you're an entity or whether you have a permanent establishment or you have a large-scale domestic group in one country if you are within the EU. So EU includes this large-scale domestic group in terms of avoiding any conflict with the freedoms. Now, the second step after you identify that you are a group, the second step is to see whether you pass the revenue threshold, and the revenue threshold is the 750 millions, which is similar with the country-by-country reporting. And the final step here is to exclude any excluded entities. There is a list of entities that they are excluded, they are not included. Then you exclude the list of entities that they are excluded. Now, under step 1.1, which is the M&E group test, here it means that if you are an entity and this entity holds another entity under the consolidation regime, or you hold a PE, this means that you are a group and you need to follow the second test, which is the revenue test. Cyprus, as I already mentioned, because we are part of the EU, we also have in our domestic law the large-scale domestic group. So this means that you don't need to be an international group, you just need to be a group in a domestic level. Now, the revenue test has a 4 years look-back period, and these 4 years start from the preceding year. So the good news for this is that if your tested year is 2024, you look at 2023, 22, 21, and 20. This means that with the beginning of each tested year, you know that you are in scope or not. And in order for you to be scope, you need to fulfill 2 out of 4 of the tested years, and this should not be cumulative. It can be any of the 4 previous years. So in this example here, you will notice that in 2021 and in 2023, you are above the threshold. And because you are above the threshold in these 2 years, this means that you are in scope. And in step 1.3, you need to exclude any excluded entities, and these entities are split into 3 categories. The first category is public interest entity. The second categories are some tax investment neutral vehicles. And the third category is certain asset holding companies which are controlled by excluded entities. So you have these 3 categories that we typically exempt from Pillar 2. Now, some additional issues to consider on the scoping rules is that the excluded entities are not subject to the revenue test. So you always include the excluded entities in the revenue test, despite from the fact that they are excluded entities. If you want to see whether you are in scope, the excluded entities are still included in the revenue test. In case that you don't prepare any consolidated financial statements, this means that you need to do a deemed consolidation test. So for any reason, the group didn't prepare consolidation financial statements, it doesn't really matter. For the purpose of Pillar 2, you need to do the test, the deemed consolidation test, to see whether you are included or not. Now, there are some special rules for multi-parent groups or dual listed or stable structure groups. These are some special rules. And there are also some special rules when it comes to merger and demerger. Again, when you are in scope, you need to have a look on merger and demerger rules. If you finish with step 1 and the answer is yes, you are in scope, then you go to step 2, which is to calculate effectively the tax base. This is your tax base. There is a question whether the slides are going to be shared. Of course, the slides were going to be shared by the association after we finish the session. Now, when it comes to step two is not calculating the tax base, is effectively allocating the income before you calculate the tax base. So what does this mean under step two? It means that you need to identify all entities, including the PEs, any hybrids, stateless entities, and so on. And then you need to determine their location, because when you are going to allocate the income, because the Pillar 2 rules, unlike GILTI, which is on a worldwide basis, it works on a jurisdictional basis. You need to allocate the income on their jurisdiction. So if, for example, you have a Cyprus incorporated company that is effectively tax resident in another country, this company will be included. Let's say this company is tax resident in France or in Greece. The income of this company will be included in France and not in Cyprus because it's tax resident there. But if you are dual resident, there are other rules that apply for dual resident entities. But what is important is that the location of his entity follows the tax treatment and where you are resident and not where you are incorporated. Now, the second rule is that you need to determine the financial income of each entity, and this is based on the standalone financial statements before consolidation. So you need to identify your profit on those financial statements, and then you allocate those profit. If, for example, you have a PE, you need to allocate the income of the PE between the PE and the head office. And finally, if you have any transparent entities, you need to allocate the income of those transparent entities. Now, when we go to step three, effectively at step three is the calculation of your tax base. This is the tax base calculation. We start from the profit, as we mentioned earlier, and then we do certain tax to book adjustments. They are certain, is not a very massive list. We explain the adjustments. So there are certain tax to book adjustments that we are effectively applying on this accounting profit. Now, these certain adjustments are effectively in the tax policy of the majority of the jurisdictions that they are included in the inclusive framework, like dividends, equity gains, losses, FX gains, losses, some stock-based compensation, and so forth. Certain adjustments we are going to explain later. There are also some other adjustments, allocation adjustments, like transfer pricing rules and intra-group financing. This is an anti-hybrid provision, and other policy adjustments like bribes, international shipping income, and so forth. These are the standard adjustments, and this is your list of adjustments. We broke them down into required adjustments. So if they are required or if they are optional, and under each category, we determine whether this is a common tax adjustment or whether this is an industry specific or necessary to reflect the other provisions of other chapters. So we have categorized them just for you to be able to assist you understanding these adjustments. This is your map of the adjustments, and you can use it freely. Now, after you determine the tax base, the next step under step 4 is to determine your cover taxes. Now, the starting point of your cover taxes, as we mentioned earlier, is the tax expense based on your standalone financial statements before consolidation. This is your starting point. And then again, you do some adjustments These adjustments are effectively adjustments based on, again, on the policy of the inclusive framework jurisdictions. And these adjustments are effectively trying to address any temporary differences which might arise between, I don't know, capital allowances and the like. There are also some cross-border allocation rules, like CFC rules, withholding taxes, and so on. And there are also some provisions for post-filing adjustments that you might end up filing your tax return, you have an error, and then you need to adjust your tax return. And then you compute your tax. So assume that under step 3, this is step 3, and this is step 4. And assume that under step 3, the tax base is 100, and assume under step 4, your tax rate is 10%. So you effectively have a 10% effective tax rate. And when you compare this with the minimum top-up tax, which is 15%, it means that you are a low tax jurisdiction and you need to pay the difference. If, however, you end up saying that this is 20, and it means that you are a high tax jurisdiction because you are at 20%, which is higher than the 15%, it means that you stop here. You don't need to do anything else. You are a high tax jurisdiction and you don't need to do any further adjustment. But if you are in a low tax jurisdiction, then your globe income, your tax base, which is, as we said, 100, can be reduced by the carve-out, the substance-based income exclusion rule. A very, very important carve-out here, guys, because the carve-out here has two components. One is payroll, and the other one is tangible assets. Now, there is a policy behind this. It's not by luck that the OECD picked up these two components. Effectively, these components are the most economically efficient components in order to have tax incentives in a country. Their spillover effect, because they are expenditure-based, these are expenditure-based components, is much higher than income-based tax incentives. And these two, the payroll and the tangible assets, are effectively the two most important factors of production, which is employees and capital. However, what is included here, the OECD excluded the intangibles. And the reason that they excluded the intangibles is because they are highly mobile, and they believe that they are very sensitive to harmful tax practices. So they excluded the intangibles for this reason. After you calculate your substance-based income exclusion rule, you do some adjustments, and you end up with your top-up tax. This is your top-up tax. Assume that your top-up tax is 100. There is 100 top-up tax. And the next question is how you allocate this top-up tax. This is the next question. Under step 6, which is the final step, you need to allocate the top-up tax with the ordering rule. And the ordering rule is first the qualified domestic minimum top-up tax. So if you have a low tax here, let's say this is a low tax jurisdiction like Cyprus, and you have top-up tax of 100, and Cyprus implemented the qualified domestic minimum top-up tax, Cyprus will get first the 100. But we have done this from next year. So for this year, it's not applicable. When I say this year, I mean 2024. But from 2025, the qualified domestic minimum top-up tax will be collected, for example, if this is Cyprus. Now, moving on to the next ordering rule. If this is not available, you move on to the IIR. That is like a super CFC rule that applies second. So if assume that you have a low tax subsidiary and you have a top-up tax here, 100, and this low tax jurisdiction didn't implement the qualified domestic minimum top-up tax, It means that if this is a Cyprus subsidiary, Cyprus will collect first the 100 here because this was not picked up by the qualified domestic minimum top-up tax. And then because the IIR follows a top-down approach, so unlike the CFC, that CFC follows a bottom-up approach, IIR works on a top-down approach, you go all the way down. So if you have any intermediary parent entity, or if you have an immediate parent entity, then all the way down, this jurisdiction will pick up this 100 here. And at the end, if there is no one to pick up any IIR, you have the backstop of the OECD, which says that if you have a low tax here of 100 and no one within the, these big charts like a Christmas tree structure, no one picked up the 100, then you have any constituent entity within the MNE group that applies the UTPR. The UTPR will be applicable and will pick up this 100. Now, this is the general rule of the OECD model rules and how the rules work in practice in our international understanding. And right now, let me dive in of how Cyprus implemented the Pillar 2 rules of the OECD, and of course, based on the EU directive. Now, the Cypriot Pillar 2 rules, as we mentioned earlier, largely aligns with the EU directive. We are a member of the EU, so we need to follow what the EU says, which, of course, we deviate a bit when this is feasible within the directive. Now, the key difference with the OECD model rules is that, of course, we have the qualified domestic minimum top-up tax. We also follow the large-scale domestic groups like the EU. We also extend the IIR to all domestic entities, not just foreign subsidiaries, which is optional in the OECD model globe rules. And when it comes to the UTPR, we apply the denied deduction and not of any other provision. And of course, we may transfer in an MNE group level the top-up tax due. So these are the main differences. Now, as you already know, the OECD model globe rules, they effectively applying the administrative guidances. So we have a lot of administrative guidance that is published by the OECD. All this administrative guidance is effectively included in the provisions of our legislation. It's in our tax code, and therefore we also implement all these rules. Now, in the Pillar 2 legislation, we also mentioned that we are following the OECD model rules, and we're also following the EU directive as defined in Article 2. So effectively, all these rules are included in the implementation of the rules. So when we interpret the directive, we take into consideration all this administrative guidance and any subsequent documents published by the OECD that they can be issued by a decree by our Minister of Finance, which is like a secondary law here in Cyprus. So this ensures that Cyprus will be implementing the OECD model rules and the EU directive align with what is expected in the international law. Very important to note that we also don't have any anti-avoidance rule within a general anti-avoidance rule within the Pillar 2 law. There is some anti-avoidance rules like the anti-hybrid rule, the transfer pricing rules, and so on. But the Pillar 2 is not mostly an anti-avoidance, full of anti-avoidance provisions, is, I would say, anti-avoidance free. Now, when we published the legislation, because all this administrative guidance was not in place at that time, we haven't implemented all this administrative guidance. but we expect that this will also happen, as I mentioned earlier, via regulation, which is secondary law, based on the Minister of Finance, where it has the ability to publish any further administrative guidance as secondary law. Now, all these elections are included in our legislation. No need to take you through. We are going to share the slides, but take into consideration that all the elections included in the Pillar 2 law are available in Cyprus. Now, another thing is that how the Pillar 2 applies the qualified domestic minimum top-up tax. Just for your reference, is that Cyprus implement the qualified domestic minimum top-up tax in the same way of the Pillar 2 rules works. So nothing surprised and nothing that you should take into consideration specifically. So we are applying the qualified domestic minimum top-up tax in the same way that we calculate the tax base. There is a question saying that when we say there is no ADIT avoidance in Pillar 2, what is the interaction of our GAR containing the income tax law with Pillar 2? Will it still apply given that the Pillar 2 is a separate legislation? This is an excellent question, because here we have two laws that they do not overlap together. So the quick answer to this is that we have the income tax law, that we calculate the income tax law. We end up calculating this for the purpose of calculating what will be the corporate tax payable on our headline 12.5% rate. We finish with that, and then you take the Pillar 2 law, which is a separate legislation. You calculate these calculations based on this law, the Pillar 2 law, and this law does not have a GAR. So the GAR that is here in this legislation is not directly implemented in the Pillar 2 legislation. So we don't see any interaction unless stated otherwise. Okay, the Pillar 2 law is massive, but we haven't noted any interaction between the GAR and the Pillar 2 law. Now, in addition to the normal standard rules that we have in practice, there are some compliance requirements. So you need to register to the Cyprus tax authorities in order to file your GLOBE information return. You have your filing requirement, is like a normal tax return, but the OECD has a standard template of how the GLOBE information return will look like, and you have 15 months to do that, to apply your and submit your GLOBE return. There are also some penalties for late filings, delayed payments, and so forth. And the next key question is how the Pillar 2 rules will impact the international tax structuring. So how your income is structured and how your structures will be affected, but not just in Cyprus, but this is around the globe. So I have this slide to discuss this a bit further. Now, the income, any income, guys, is taxed in two different ways. We have two types of income. The one is active or business income. I mean, name it as you like. And the other type of income, which is split into two categories, is passive or investment. Now, the active income is split again into two subcategories, which is the sale of goods or the rendering of services. And in practice, we typically use trading companies or service companies when it comes to this type of income. Now, the key question is that what is the impact on these two companies in the Pillar 2 era? The impact is that there is nothing in the Pillar 2 provision for providing any incentives or not. So I will say that the active income, in case you don't have any tax breaks, it will be taxable normally within the Pillar 2, and there is no provision in the tax to book adjustment, all these adjustments that I provided earlier, specifically for trading of goods and services, other than the normal transfer pricing rules that they are included in the Pillar 2 rules. Now, the other category that we have is effectively the passive income, and passive income typically is split into 4 categories: dividends, interest, royalties, and rental income. And these 4 different categories, you will see in practice that tax advisors, they use the holdco, the finance co, IP company, and your propco. And typically it's these type of companies. For example, if you have your finance co, it will have interest income and gain on sale of your loans. Now, there is an impact on these companies because different rules apply when it comes to the Pillar 2. There is another question. If the auditor of the M&E group identifies that the group falls under Pillar 2, is there an obligation to the auditor to inform the tax authorities if the group fails to do so? The quick answer on this question is that the responsibility, on top of my head, if I remember correctly, it falls under the directors. So I don't think that the auditor will normally be obliged to register the company for the Pillar 2 rules. It will normally be the director. Now, what is the impact on these type of companies? Let me start with the good news. As I mentioned earlier, the holding company, the income is exempt. So since the income is exempt, the holding companies remain untouched. However, there are some preconditions here in order to exempt the income, and this is you should normally be a short-term portfolio shareholding. If this is the case, then the dividend income is not exempt. So this effectively applies for majority shareholding, which is more than 10%, because if you are below, then it means that the dividend income is not excluded, and therefore it is taxable. The same, the rules for the gain on sale of shares are similar, again, is below 10%. Now, moving on to the impact on the finance company. The finance company, they don't have, again, any specific rules. All the income is normally taxable. However, there are 2 rules that they impact the finance company. The one, as we mentioned, are the TP rules that apply to all transactions. And the other one is Article 3.2.7, if I remember correctly, that effectively applies the anti-hybrid rule. So if, for example, you have a company which is in this is a low tax jurisdiction, and this is a high tax jurisdiction, and you have a payment, and this payment here is deducted, and here you have not a commensurate increase of the income in the high tax jurisdiction. So this means that here you get deduction, and here maybe you get a non-inclusion, because this is, say, debt, and this is equity. And because here you get the deduction, these anti-hybrid rules will pop in not to get the deduction in the low tax jurisdiction. Now, when we move on to the third one, which is the IP companies. IP companies, again, there are no specific rules when it comes to IP companies. But as we mentioned earlier, any IP box regime, any benefit of the IP box is washed out. Typically, companies that they have intellectual property, the IP box is washed out, or if you have any other tax incentives. However, there is a specific incentive called refundable qualified tax credits. If you have refundable qualified tax credits, this is something that you can artificially increase your denominator, and these are usually provided in IP industries. And finally, when it comes to your property companies, rental income and gain on sale of shares is taxed as normally, and there is no specific provision for these type of transactions. And finally, this is my last slide. The OECD has produced an extremely very important report when it comes to what is the tax policy consideration on tax incentives when it comes to Pillar 2. Any tax policymaker should read this report, not just for Pillar 2, but it also shows how the tax incentives will move on to the future. And this is the most important part. The OECD shows the future of the tax incentives because you will see that the OECD classifies here the tax incentives in a more green category. If you are more green here, it means that the Pillar 2 will impact you more. And if you are more white, it means that Pillar 2 will impact you less. What does this mean? It means that the tax incentives that the OECD has chosen not to be impacted by the Pillar 2 are the most economically efficient tax incentives where the spillover effect is higher and it's positive in the economy rather than having a negative spillover effect. And this is obvious because if you choose to go with the income-based tax incentives, like the IP box, you will see that these tax incentives are more likely to be affected. So the OECD does not encourage countries effectively in a Pillar 2 era, but this is a general policy to provide income-based tax incentives, whereas the expenditure-based tax incentives, you will see that they are less likely affected, in particular to those that they are immediate expenses or accelerated depreciation on tangible assets or other assets, and also the qualified refundable tax credits, as I mentioned earlier. These will have the less impact when it comes to Pillar 2. So in general, the most important tax incentives that we see in practice based on expenditure-based are the accelerated depreciation or immediate expensing. This is the one. The second one is the super deductions. Super deductions means that instead of getting 100% of deduction, you might get 150 or 200. And the third one is the qualified refundable tax credits. These are the most important, I will say, benefits that the tax policymakers need to focus when providing tax incentives. These are the most important ones. And from these, the tax policymakers, they need to decide which one is the most, I will say, benefit for the economy. Now, everything that we said here, we have the reference here in the slides. You can effectively click here and find anything that you like the Pillar 2 rules, the EU directive, the administrative guidance, and I also included a few articles written by myself when it comes to Pillar 2, and also the link to buy the book in case that you are not one of the lucky person. Let me mention at this stage before we go to the Q&A session that for last time, this is the book that we are giving for free today to one lucky person. Feel free to drop an email to Urania Eleftheriou. Let me write down the email here in case you cannot see it. The email is eleftheriou@stitaxand.com. Feel free to drop an email and we are going to include you in the draw. We are going to pick one lucky person at the end and we are going to send you the book. So this is where I finish. Thank you, much appreciated. And any question that you have, we are happy to take them at the end. This is the Q&A session. Of course, we answer a lot of questions as we go along, but we are happy. I think we have like 5-6 minutes more, and we are happy to take any more questions.
Thank you very much, Christos. That was excellent. And yes, thank you as well for answering some of the questions as you went through. We'll give our participants a few minutes to type in any further questions they may have. In the meantime, obviously, a huge thank you again to you and your team at Taxand for the prize draw. So hopefully, yeah, the one lucky recipient will be delighted to get the book and obviously learn a lot more about the topic. We have obviously plans to do more ADIT network webinars for our Cyprus network over the course of the year. We're always looking to do as many of these events as possible, particularly for our champion-led networks, where we have lots of students and ADIT holders who are really interested in learning about the relevant topics that are specific to their respective parts of the world. So please do, everybody, keep in touch with us. We've got obviously our main global ADIT LinkedIn group. We've also got a Cyprus LinkedIn group that you can join and follow that way. And obviously we post information about our webinar program on our website as well. We are going to be delivering some kind of global ADIT webinars as well over the course of the year, and no doubt there'll be more mention made of Pillar 2, with it being such a key topic on the current international tax agenda. Okay, question that's just come in there. If a
Yes.
company is already registered to the Cyprus tax authorities, does it have to be registered again for Pillar 2? Is there a special registry for Pillar 2, like Ariadne?
Yes, you need to notify the tax authorities that you are in scope, and this is a different procedure that you need to notify the tax authorities. So yes, this is the answer is positive. And also, many thanks, Baniko. You are welcome.
Just a further bit of housekeeping as well from my side. Those of you who've joined today and would like to revisit some of the content from the slides, or obviously anybody that's unable to view it live but wants to view the webinar at a later date, we will be sharing obviously a recording, as we always do, a recording of the webinar, as well as the slides, the PowerPoint slides, via email. So everybody will be getting an email in the coming days with those resources.
There is an excellent question from Savas Rory, how Pillar 2 is affected by the Trump election. Let me say that this is an excellent question. Let me say that the US has never been in favor of the Pillar 2. So we haven't seen something new from the US administration. What we see now is picking up a more aggressive stance on this, because the US has never been in line and they didn't want to apply the Pillar 2. So it's not that now they're going to apply the Pillar 2 rule, but what they're trying to do right now is to avoid the UTPR provision, because don't forget, guys, that the Pillar 2 rules, the IIR and the UTPR, they have been, let's say, received and used from the US. So IIR is guilty and the UTPR is the bid. So this is like a US functioning mechanism that effectively the OECD was very smart on this. They applied the UTPR in all jurisdictions and works as a backstop. So if we go back to the ordering rules, we see that the qualified domestic totals will get first, all the IIR and the UTPR at the end. So typically, we don't expect, the OECD, my understanding is that they don't expect to get much money from the UTPR. So the majority of the revenues will be collected by the other mechanism, but the UTPR is there to work as a backstop to those that they want to be included there. So it's like waiting there, using and frightening jurisdictions to pop in. So what I suspect it will happen is that there should be a common agreement between the US and the OECD and the EU with respect to the UTPR, which effectively what the US government right now is opposing is about the UTPR. I understand that the IIR, they are not opposing because this is something that they are also applying, which is effectively the guilty. So they're not applying something different. And like with the UTPR, they are applying it like the bid, but on a bit different basis. So I would say that there will be a discussion between the two. There will be a common agreement to end up to an agreement on that part. So I'm not expecting that the US will join the Pillar 2. The US has never joined any multilateral instrument. We've seen this in the past. So no one expects the US to join Pillar 2 because it's a multilateral agreement. But yeah, the Trump elections shows that Trump will want to renegotiate the UTPR rules. So we are there.
No. We are at the end of our appointed hour, so unless anybody has any further quick questions, we'll wrap things up now. I'd like to say, obviously, on behalf of the CIOT, a huge thank you to Christos for his time and his insights on today's webinar. And a huge thank you to everybody that signed up for it. Obviously, all of our questions we've been posed. We have actually just got one further one coming. I don't know if you have time to answer that one
Yes.
quickly, Christos. But yeah, obviously a huge thank you from myself and everybody at the CIOT.
Likewise, Rory, for providing me this opportunity to enlighten the ADIT candidates and the ADIT community here. So here is that can the tax authorities adjust the consolidated revenue and capture the companies who are transacting with related parties at price below market? Or shall we follow only the accounting consolidation income for the calculation of the threshold of the 750 million? The revenue test is a consolidation test and not something that you adjust on your tax. So it's not effectively a tax adjusted revenue. It's an accounting revenue test, but it's difficult to apply this because in the consolidation test, this is a very good question actually. In the consolidation test, you don't include the intercompany transactions because they are eliminated. So presumably all the transactions on the consolidation, they are on market value because you don't include, you eliminate the intercompany transactions when you prepare your consolidation test.
Wonderful. Thank you very much. And so, yes, it just leaves it with me to wish everybody a good day, the rest of the day. And please do stay in touch for news on further ADIT webinars. Thank you, everybody.
Thank you, guys. Much appreciated.